Good morning and welcome to the ADS Securities Markets Update. Today is another calm day ahead in the market ahead of a busy week with many economic news and events in addition to a central bank's decision which is likely to have a major impact on the market during the week. But today we will start with a look at the key US jobs report which was released basically on a Friday, which came in also with a huge miss. As noted in our previous non-farm payrolls preview sent to all our clients earlier earlier on Friday, the US jobs report came in with a huge miss and a huge disappointment, increasing the speculation for a pause by the Federal Reserve in the next few meetings. But starting with the non-farm payrolls, the U.S. economy added only 126,000 in new jobs in March, despite the fact that the estimates were to add more than 245,000 in new jobs. Moreover, February's reading has been revised even lower toward 264,000. Down from 295,000, and this is the weakest jobs growth since December of 2013. Furthermore, the two-month payroll net revision came in also at minus 69,000 jobs. Secondly, we've seen also the change in the private sector also came in with another huge disappointment, adding only 129,000 new jobs in March, while it had been anticipated to add more than 325,000 in new jobs. Moreover, February's reading has been revised even lower toward 264,000 instead of 288,000, and this is the lowest reading since December of 2013. The manufacturing payrolls also unexpectedly lost more than 1,000 in new jobs in March, while the estimates were to add more than 10,000 in new jobs. Moreover, February's reading has been revised sharply lower toward 2,000 instead of 8,000, and this is the first job loss in the manufacturing sector since July of 2013. Also, the unemployment rate stabilized at 5.5 as widely expected. However, the change in the household employment also disappointed, adding only 34 in March compared to 96 in February, while the estimates again were to add more than 245 jobs, and this is also the lowest reading since April of last year. The labor force participation rate also ticked lower towards 62.7, down from 62.8, matching the lowest level since 1973, while it had been anticipated to remain stable, leading the people out of the labor force to soar to a record high toward 93.2 million workers. The wages growth was the only positive number in this report. The month-over-month average earnings increased by 0.3% in March compared to 0.1% in February, while the estimates were to rise by 0.2%. Moreover, the year-over-year hourly earnings also increased toward 2.1%, up from 2% during the same period. However, the USD reaction was very massive, and the trader had a wild run on the US dollar yesterday or on Friday, right after the announcement, leading the euro to jump above 110, reaching as high as 110.30, and the cable or the sterling dollar also reached 149.45. Dollar yen also tumbled below 18.80 yesterday or during Friday, and dollar Swiss also traded toward 94.90. Aussie and Kiwi also spiked more than 70 pips for each, reaching as high as 76.95 and 76.30 respectively. Finally, we had the dollar CAD also tumbled more than expected, or tumbled further toward 24.30, and gold already began the week higher, trading above 12.19 so far. As for the U.S. equities, despite the ugly U.S. jobs report, the U.S. futures closed the day lower with more than 1%. S&P tumbled by more than 20 points right after the announcement, closing the week at 20.39. And it seems that equities is continuing considering the wages growth more than the jobs growth. In other words, the U.S. dollar decline could resume or could be another short-term wave. And next week or this week, basically, the buying the dollar on the dips may resume again, unless the upcoming economic data kept on disappointing. Right after the decision again, the speculations for a sooner rate hike by the Federal Reserve has eased significantly a few days ago, or before the U.S. jobs report. There were more than a 55% chance for the Federal Reserve to raise interest rates in June. However, right after the announcement, there are only 44% predicting a rate hike in June, while the percentages increased sharply for a rate hike in December, and we maintain our cautious view in the meantime, waiting for further evidences in the next few weeks. As for today, there are only a few economic releases from or across the day from the U.S., and as other markets are closed due to the Easter break, therefore volatility likely to remain lower until the U.S. session. The US Services PMI, the Final Services PMI from market, may also remain stable at 58.6 in March. However, the ISM Non Manufacturing PMI is expected to decline again toward 56.6 in March, down from 56.9, which would be also the lowest in 3 months. However, the labor market condition index will be released at 14 GMT time with no future estimates. Finally, in Canada, the PMI or the manufacturing PMI may improve again above the 50k level toward 51.1, up from 49.7, which would be the first reading above the 50k level in almost 2 months. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching.